If you're just getting started investing, or if you've been investing for a while and want to try something new, you have a lot of options. Stocks, exchange-traded funds, ETFs, mutual funds, commodities, currencies, and bonds are all available, as are derivatives of each. Depending on your priorities and investment risk tolerances, you want your investments to perform well, return profits, or develop. Each investment option has its own set of advantages and disadvantages. Many investors find it difficult to decide what to invest in, particularly when deciding between stocks and ETFs, because there are so many options. It's crucial to understand the distinctions and complexities for each so you can make an informed decision that suits your investment goals. Investing in stocks. Both stocks and ETFs are generally referred to as reserves and securities. Although these words can appear to be perplexing, they are not. A security is an asset that you can sell in full or in part, and an asset is something of value you own. Stocks, also known as equities, are ownership securities sold by businesses in order to collect funds. If you buy preferred shares, a share of stock gives you a portion of voting equity in a company. Relinquishing voting rights brings higher priority in payment and often higher payments than common shares. Stocks are traded mainly on stock exchanges such as the New York Stock Exchange, NYSE, and NASDAQ. The valuation of stock depends on a variety of factors, including the company's financial performance and structure, the economy, the market in which it operates, and many others. ETFs, exchange-traded funds, are a form of pooled investment that is professionally managed. The ETF managers would purchase stocks, commodities, bonds, and other securities to create what is known as a basket of funds. The funds in the basket are referred to as holdings. Following that, fund managers sell shares of their portfolios to investors. There are also inverse funds, which are intended to move in the opposite direction of the market with the aim of hedging the risk of their portfolio. Hedging is the term for buying assets that would minimize the risk of market shifts that may result in losses. Inverse exchange-traded funds, ETFs, carry a high level of risk. While they can protect investors in a down market, inverse ETFs can lose value just as easily as they gained it if stocks recover. They're not supposed to be long-term investments, so investors can think about whether the risk is worthwhile. ETFs and stocks. What are the risks? Many factors influence investments, including company executive turnover, supply issues, and shifts in demand, to name a few. Investments are therefore subject to inflation risk, which is described as a loss of value due to decrease in the value of currency. For example, you could obtain a $1.50 distribution from a stock issuer one year, only to see inflation increase the following year. The $1.50 you get next year will buy less than it did last year, making it less valuable. Interest rate risk, which affects bonds, the risk of rates increasing, lowering the bond's price, and liquidity risk, or the risk of not being able to sell an investment if prices fall, are two other threats to consider. A metric called beta is used to determine a stock's volatility. This is a metric that compares the volatility of a stock to the volatility of the market in which it trades. The beta of a stock can be used to calculate and communicate danger. A beta of 1.0 indicates that its volatility is equal to the market's. A beta of less than 1.0 indicates that its volatility is less than the market's. And a beta greater than 1.0 indicates that its volatility is greater than the market's. Since an ETF is a mini portfolio or basket of investments, it is slightly less risky, so it's quite diversified, but it still depends on the ETF itself. If you invested in an oil and gas ETF, you'll be taking on virtually the same risk as if you bought a single stock. ETFs, on the other hand, may be able to resolve this by distributing their shares across the world, holding natural gas as well as oil stocks, or diversifying the basket in other ways, using a hedging strategy. ETFs versus stocks, liquidity factors. The ease with which you can turn your stock or ETF holdings into cash or another investment is referred to as liquidity. When it comes to stocks, it all depends on the company issuing the stock. You would have no trouble trading shares if they are a well-established, financially sound, and high-quality stock, also known as a blue chip stock. Penny stocks, on the other hand, can take weeks or days to trade, if at all. For the most part, ETFs are almost as liquid as stocks. It will rely on the quality of the items in the ETF's basket once again. Liquidity will be affected by the fund's trading volume. Stocks and ETFs have tax consequences. Dividend income, profits returned to investors, from stocks and ETFs will be taxed by the Internal Revenue Service, IRS. If you sell a stock or ETF for profit, you will still have to pay capital gains tax. Any rise in value over the price you paid for the protection is referred to as capital gains. You can subtract your losses up to a certain amount, which helps offset the overall value from which capital gains are measured. Dividends are treated as profits unless they meet the qualifying dividend requirements, in which case they are taxed as capital gains. Any commissions or fees you paid to trade the investment are not deductible. These costs, along with taxes, must be offset with dividend payments or growth. Income streams from stocks versus ETFs. Your dividend-paying stock portfolio will provide you with a steady stream of income. Most businesses distribute income to their shareholders. A dividend aristocrat is a company that has been shown to increase its dividend year after year. Through their portfolio of holdings, ETFs may also produce income streams. Bonds, corporate and government debt instruments, are often used by mutual funds to invest a portion of their assets. After deducting costs, they will distribute the earnings from these investments to shareholders. A bigger picture. Exchange-traded funds, like bonds, carry risks. Although they are generally considered to be safer investments, some may still provide better than average returns, while others may not provide any returns at all. It also depends on the fund's sector or industry of focus, as well as the stocks it holds. Stocks can and often do show greater volatility as a result of the economy, global events, and the company that issued the stock. ETFs and stocks are similar in that they can be high, moderate, or low risk, depending on the assets held in the fund and their risk. Your personal risk tolerance will play a major role in determining which option is best for you. Both charge fees, are taxed, and generate revenue streams. Every investment decision should be based on the individual's risk tolerance, investment goals, and strategies. What is suitable for one investor may not be suitable for another. When you study your investments, keep these fundamental differences and similarities in mind. Thank you for listening, and make sure to subscribe so you won't miss out on your path to success.